Welcome to our channel. This is gonna blow your mind. In the rapidly evolving landscape of modern business, understanding and tracking growth metrics are critical for any company aiming to achieve sustainable success. Growth metrics provide insights into various aspects of business performance, helping companies gauge their progress, optimize strategies, and drive long-term profitability. By focusing on the right metrics, businesses can make informed decisions, enhance operational efficiency, and foster scalable growth. This essay delves into the top 5 growth metrics every company should track: customer acquisition cost, customer lifetime value, monthly recurring revenue, churn rate, and revenue growth rate. Each metric plays a pivotal role in evaluating different facets of business performance and guiding strategic planning. Number 1. Customer acquisition cost. Customer acquisition cost measures the total cost a company incurs to acquire a new customer. It is a crucial metric for understanding the efficiency of marketing and sales efforts. CAC includes expenses related to advertising, marketing campaigns, sales, team salaries, and any other costs associated with bringing in new customers. Tracking CAC helps businesses assess whether their customer acquisition strategies are cost-effective, and if the investment in gaining new customers aligns with the overall financial goals. The formula for calculating CAC is customer acquisition cost equals the total cost of acquiring customers divided by the number of new customers acquired. For instance, if a company spends $100,000 on marketing and sales in a given period and acquires 500 new customers, the CAC would be $200. Several factors can influence CAC, including marketing channels, sales team efficiency, and customer targeting. The effectiveness of different marketing channels, such as social media, paid search, and content marketing, impacts CAC. Some channels may be more cost efficient than others. The productivity and skill of the sales team can affect CAC, as a well-trained and effective sales team can reduce the cost per acquisition. Precise targeting of potential customers can reduce CAC by improving conversion rates and minimizing wasted spending on less relevant audiences. CAC should be evaluated in conjunction with customer lifetime value. If CAC is significantly higher than CLV, the company may be spending too much on acquiring customers relative to the value they bring. An ideal scenario is a CAC that is lower than the CLV, indicating a profitable acquisition strategy. To reduce CAC, businesses can optimize marketing channels by focusing on those that yield the highest return on investment and refining targeting strategies to attract high-quality leads. Improving conversion rates by enhancing website design, sales processes, and customer engagement strategies can also help reduce CAC. Additionally, leveraging referral programs can encourage existing customers to refer new customers, often at a lower cost than traditional marketing methods. Number 2. Customer lifetime value. Customer lifetime value represents the total revenue a company can expect from a single customer over their entire relationship with the business. CLV is a vital metric for understanding the long-term value of customers and guiding strategies for retention and growth. By estimating CLV, companies can make informed decisions about how much to invest in acquiring and retaining customers. The formula for calculating CLV is customer lifetime value equals the average purchase value multiplied by the purchase frequency and then multiplied by the customer lifespan. For example, if a customer makes purchases worth $100 per month, buys once a month, and remains a customer for 3 years, the CLV would be $3,600. Understanding CLV helps companies allocate resources effectively between customer acquisition and retention. A higher CLV justifies investing more in acquiring new customers, while a lower CLV may prompt a focus on improving customer retention and increasing the average value of transactions. To increase CLV, businesses can personalize the customer experience by tailoring interactions and offers to individual customer preferences, enhancing satisfaction and loyalty. Implementing loyalty programs with rewards and incentives can encourage repeat purchases and increase customer retention. Additionally, upselling and cross-selling complementary products or premium services to existing customers can boost their overall value. Monthly recurring revenue, often referred to as MRR, is a key metric for subscription-based businesses. It represents the predictable revenue a company earns each month from active subscriptions. MRR provides insight into revenue stability, growth trends, and overall business health. Tracking MRR helps businesses forecast future revenue and make data-driven decisions to scale operations. The formula for calculating MRR is MRR equals the number of subscribers multiplied by the average revenue per user, or ARPU. For example, if a company has 1,000 subscribers each paying $50 per month, the MRR would be $50,000. There are different types of MRR to consider. New MRR is revenue generated from new customers acquired during the month. Expansion MRR comes from existing customers who upgrade their plans or purchase additional services. Contraction MRR is the revenue loss due to downgrades or reduced spending by existing customers. And finally, churned MRR represents the revenue loss from customers who cancel their subscriptions. Monitoring MRR trends helps businesses assess their growth trajectory and identify patterns in revenue generation. Increasing MRR indicates successful expansion and customer retention efforts, while declining MRR may signal issues that need addressing. To increase MRR, businesses can optimize their pricing strategies by experimenting with different models and tiers to maximize revenue from various customer segments. Enhancing customer engagement by fostering strong relationships with customers can encourage upgrades and long-term subscriptions. Additionally, developing new features and continuously improving product offerings can attract new subscribers and retain existing ones. Churn rate measures the percentage of customers who discontinue their relationship with a company over a specific period. It is a critical metric for assessing customer satisfaction and retention. A high churn rate indicates potential problems with customer experience, product quality, or service delivery. The formula for calculating churn rate is churn rate equals the number of lost customers divided by the total number of customers at the start of the period multiplied by 100. For instance, if a company starts the month with 1,000 customers and loses 50 by the end of the month, the churn rate would be 5%. Several factors can influence churn rate. Poor customer service can lead to dissatisfaction and higher churn rates. Issues with product performance or service delivery can drive customers away, and attractive offers from competitors may lure customers away if not addressed. A high churn rate may indicate underlying issues that need to be addressed to improve customer retention. Analyzing churn in conjunction with customer lifetime value, or CLV, and customer acquisition cost, or CAC, helps businesses understand the financial impact of losing customers and develop strategies to mitigate it. To reduce churn rate, businesses can enhance customer support by providing excellent service and resolving issues promptly. Gathering customer feedback regularly and analyzing it can help identify and address potential problems. Additionally, investing in product development and quality improvements can meet customer needs and expectations. The revenue growth rate measures the percentage increase in revenue over a specific period. It is a fundamental metric for evaluating a company's overall growth and financial performance. Tracking revenue growth helps businesses understand their market position, assess the effectiveness of growth strategies, and set future financial goals. The formula for calculating revenue growth rate is revenue growth rate equals the current period revenue minus the previous period revenue divided by the previous period revenue multiplied by 100. For example, if a company's revenue increased from $1 million to $1.2 million over a year, the revenue growth rate would be 20%. Revenue growth should be analyzed in the context of industry benchmarks and market conditions. A consistent and positive growth rate indicates a successful business strategy, while a declining or stagnating growth rate may signal challenges that need to be addressed. To sustain revenue growth, businesses can expand their market reach by exploring new markets or geographic regions. Diversifying product offerings by introducing new products or services can attract a broader customer base and drive additional revenue. Forming strategic partnerships with other businesses can also help access new customer segments and enhance growth prospects. Tracking growth metrics is essential for any company striving to achieve and sustain success in a competitive business environment. Customer acquisition cost, customer lifetime value, monthly recurring revenue, churn rate, and revenue growth rate each offer valuable insights into different aspects of business performance. By monitoring these metrics, companies can make informed decisions, optimize strategies, and drive long-term growth. Understanding and leveraging these growth metrics not only helps businesses navigate challenges, but also empowers them to seize opportunities and achieve their strategic goals. As the business landscape continues to evolve, staying attuned to these key metrics will remain crucial for sustaining success and driving future growth.